All right, let's start with a recap of the market last week because I know we've got a big change in our market posture. Our CTI is -3. That opinion ratio is continuing to move uh, towards the negative as we've been alluding to the last couple weeks. So definitely want to talk with you about last week's market letter and what you're seeing for this week whenever you're ready.
Okay. Well, we had a wild week last week, very volatile, and actually ended up with probably the worst week we've had in the market since I believe May or so. A lot of stuff going on, a lot of economic jolts hitting the market. We had the Federal Reserve leave rates unchanged midweek, and then we also had the deadline for tariffs that came across, I believe, on Thursday and Friday. And then we had higher rates came out on several countries, like India was 25% and Switzerland was up. Then we got hit with a jobs report on Friday that was below estimates and a huge revision down. But anyway, what it came out showing was we have probably a substantially weaker labor market than what the market was looking for. Now, the day before, on Thursday, after we had the FOMC meeting announcement on rates that they left unchanged, we actually had the probability of a September rate cut drop all the way down to 37%. And then with Friday's jobs report, we had that jump back up to 80% probability of a September. And then also this morning, they're looking at maybe 3 rate cuts. So because of that, that we had this last jump in the market on hopes that we would probably get at least 2 rate cuts. And now looking at 3 rate cuts. And of course, the market loves lower rates. And we've almost regained all that we lost last week, this morning and Monday in the market. Not sure whether it's going to hold or not. I have some resistance lines up here around 44.3 on the Dow. We'll see if it gets to that. If you're looking to short, that might be something to look at. But the market loves rate cuts, and that's what we're looking at now, 3 instead of just 1 on Thursday of last week. And that's why you're seeing this big turnaround in the market. And we also had some volatility from earnings. We saw big swings in winners and losers. As far as the big winners went, we had Carvana, Microsoft, Meta Platforms, and they surged on big beats for their second quarter and raised guidance. And on the other side, you had companies like Whirlpool, Align Technologies, United Health Group, Amazon, Anheuser-Busch. They got hit pretty hard. Most of them down at least 10% or so after coming up a little bit short or maybe even offering a lighter guidance than what the market was looking for. We also had a hit on the pharmaceutical stocks last week where President Trump sent out some letters, I believe on Wednesday or Thursday, telling them he wants to see lower drug prices, and that sent most of the drug companies down quite a bit lower. In fact, the healthcare sector was down about 4% on the week. That was one of the worst sectors. Every other sector was pretty much down too, but the materials were down 6%, consumer discretionary, financial REITs, and the industrials were also down more than 3.5%. So overall, it was just a kind of a bad week. The market had been, by some measures, was a little bit oversold, especially on like the 14-day RSIs that had been trading up in the mid 70s, which you normally don't want to buy when that's going on. You want to see it pull back to maybe some little less momentum on that. But as far as what we saw going up, defensive sectors, I mentioned this several times in the daily comment. We saw the defensive sectors, that includes utilities, consumer staples, some of the healthcare stocks and REITs. They outperformed a little bit, and the utilities actually hit a new high last week. Despite that, the index is hitting a new high midweek, including the S&P 500 and NASDAQ and NASDAQ 100. We did end up lower, and those indexes snapped a 2-week win streak. The Dow had been down the previous week before, but it was also down here. So what we're looking at this week is how yields are going to react to tariffs and trade deals. We had some decent news this morning. We did have some more earnings come out. Tyson Foods beat, Wayfair beat estimates. Also this morning, we're seeing a big jump in the Mag 7 stocks with that sell-off on Friday. Now everybody's jumping back in. They're buying Microsoft, Meta Platforms, Tesla, and the Mag 7 again. As far as the technical condition of the market goes, it did deteriorate last week, and we actually moved our market posture to bearish. We've been neutral for the last couple of weeks, but we are a little bit extended. We have several of the cycles look like they're getting close to bottoming out, and it looks like probably another 2 weeks where we could see a rough market. That goes along with seasonality. August is normally a pretty rough month for the market. So we want to watch that. I don't think you're going to see much. You get an overreaction today to the possibility of going from possibly one rate cut for the rest of the year to three. That's a big move. If we get more people talking about that, that's definitely on the table, then maybe this thing just kind of bumps a little bit, stays range bound for the next couple of weeks as they sort that out. Because you had a pretty decent sell off on Friday. I'm actually a little bit surprised that we've almost retraced that whole thing today. We'll see how it goes over the next couple of weeks. This is kind of a light week for economic data. There's a lot more earnings coming out. It's not quite as heavy as last week, but we have Nike this week. We have Caterpillar, I think tomorrow. We have Palantir tonight after the close. Let's see what else we have. We got McDonald's, Walt Disney, Eli Lilly on Thursday. Tomorrow, Caterpillar, Arista Networks, Apollo Global Management. So, some heavyweights coming out this week with earnings, but not like last week where you had most of the Mag 7 reports. I think you're probably going to get some upside resistance here around 44.3 on the Dow. I don't expect to see us get much higher than that. I think then we'll kind of bump around here to see what happens with how people talk about interest rates going further for the rest of the week. Market breadth last week was also negative. We did see a little jump in the VIX. In fact, the VIX today is it's coming down. It's down about 10%, so a little bit less worried. It's something you want to kind of watch. Normally, when you have a sell-off that's going to continue, you'll see that VIX probably jump up close to 25 or so. We got to 20, which was a little bump in the road, but it wasn't a real everybody running for the sidelines type of sell-off, surprisingly. And I think that was due to the fact that perhaps bad news is good news for the market as far as the jobs market goes. Investor sentiment, again, kind of a mixed bag. Retail clients or retail investors actually got a little bit more bullish last week. These are reported midweek around Wednesday. But the pros, they pulled back for a fourth consecutive week. They were about 99% invested here about 4 weeks ago, and they're down now to about 76.9%. So a little bit of caution there. The big news that I didn't really hear anybody talking about was that margin balances hit a record high in June, where they're over $1 trillion. And that's looked at as a contrarian indicator. Before, when we've gotten close to that, we've had a pretty good sell-off. In fact, the last record high we had was in October of 2021. And then we saw the market fall back about 20% over the next several months when you got to that margin level. Part of that is because once you get those high levels, if we have a pullback like we did on Friday, and that's followed up with another one, say if we were down another 400 or 500 points today, then you would start getting margin calls and people would be forced to sell things, and that exasperates the market move on the downside. That record margin thing, I think we'll probably see some of that come off, which means a little bit of selling from long positions. But that is a red flag for the broader market. If by chance we would see that go up even more in July, I think you would really want to pay attention to that. Again, it usually precedes a pretty good drop in the market. So that's about it for what we have coming this week. Like I say, it's going to be a light on the economic data this week. Earnings will be good. There's about 80% of the companies that are reporting are beating right now. They had cut earnings estimates previously like they normally do. But in general, I don't see anything that's going to just slam the market, except for the fact that we're overextended. And again, with a slowing jobs market, that's one of the things the Federal Reserve wants to keep an eye on. If we start to see inflationary pricing because of the tariffs, that's going to put the Fed in a tough spot, because I think they're more interested also in keeping inflation down. They won't be able to really move to cut rates to stimulate the economy if inflation is going up. So we kind of want to watch that, because I think if we see inflation tick up a little bit higher here over the next week or two, that would probably cause the market a little bit more downside. So for the next week or two, despite the volatility that we're seeing right here, I think you probably just want to take it easy and just kind of stay on the sidelines for now. Instead of rushing in to buy every dip like we did today, I would recommend giving it a little breathing room and see how these yields are going to move here over the next couple of weeks.
All right. Very good. Thank you very much, David.
All right. I'll see you tomorrow morning.
Perfect.